Soviet depression. The Soviet economic downturn of the 1980s is widely regarded as one of the most critical turning points in modern history, a key factor contributing to the eventual dissolution of the USSR in 1991. Though the peak of the crisis emerged in the late 1980s, its roots extended across decades of centralized planning, low productivity, lack of innovation, and an outdated economic model. The slowdown affected not only financial and industrial output, but also triggered a broader wave of social unrest, political uncertainty, and the gradual decline of the international influence the USSR once held. This economic strain paved the way for systemic changes across Eastern Europe and marked the final chapter of the Cold War era. The deeper causes of the crisis stemmed from structural inefficiencies in the command economy. For years, the Soviet Union prioritized heavy industry and defense over consumer goods, services, or civilian technologies. The rigid management system created large state-owned enterprises that lacked performance incentives, while wages and job security were often disconnected from results. Administrative complexity grew, and inefficiencies became entrenched. As early as the late 1960s, growth began to slow, and by the 1970s, the Soviet economy entered what historians now refer to as the era of stagnation, particularly under the leadership of Leonid Brezhnev. Entering the 1980s, a sharp drop in global oil prices significantly reduced the USSR's export revenue, a major source of foreign currency. As earnings declined, Moscow found it increasingly difficult to maintain domestic programs and provide support to allied countries. Agricultural output also weakened, and the country began importing grain, once seen as an unimaginable move for a socialist superpower. The economy became increasingly unbalanced. Heavy industry was overbuilt, while consumer goods remained scarce, and internal supply chains struggled to keep up with basic needs. To address the crisis, Mikhail Gorbachev, who rose to power in 1985, introduced two major reform programs: perestroika, economic restructuring, and glasnost, political openness. But instead of stabilizing the economy, these reforms unintentionally accelerated the disruption. State enterprises were granted more autonomy, but without a clear transition to a functioning market system, price controls became inconsistent, and distribution systems faltered. Production lagged behind, hidden inflation increased, and consumer goods became even harder to find. The old system no longer functioned efficiently, and the new one had yet to take shape, leading to widespread uncertainty. By the mid-1980s, key economic indicators began to decline rapidly. GDP contracted, inflation accelerated, and budget deficits widened. Traditional supply systems failed to meet public needs. Rationing returned, and citizens often stood in long lines for basic goods. While wages and costs rose under enterprise reforms, productivity remained flat, prompting the government to increase the money supply, further fueling inflation. At the same time, public dissatisfaction intensified. Strikes and demonstrations began to appear in various regions. Nationalist movements gained traction across republics such as Lithuania, Ukraine, Georgia, and Armenia, with growing demands for greater autonomy or full independence. Gorbachev found himself caught between conservative factions and more radical reformers. His last major effort, the ambitious 500 Days program to transition toward a market economy, was eventually halted. By 1991, the economic situation had become critical. Industrial output declined, inflation surged, and inter-republic economic cooperation broke down. A wave of declarations of independence followed, and after a failed coup attempt in August 1991, the Soviet Union formally ceased to exist on the 25th of December 1991. The economic consequences were far-reaching. After 1991, post-Soviet states, especially Russia, Ukraine, and Kazakhstan, entered a period marked by rapid inflation and falling output. GDP in Russia, for example, contracted by nearly half in less than a decade. public services weakened, employment declined, and poverty became widespread. As state assets were privatized, newly emerging interest groups, including oligarchs and informal networks, quickly gained control over vast sectors of the economy. Inequality widened, and regulatory systems struggled to keep pace. On the political front, the breakup of the USSR did more than dissolve a federation. It signaled the loss of legitimacy for the broader socialist model. Many successor states shifted toward market-based systems and sought closer ties with Western institutions, while others faced prolonged instability. In Russia, relative stability only began to return in the early 2000s, aided by rising energy prices and a more centralized approach to governance. The global impact of the Soviet economic crisis extended far beyond its borders. The geopolitical balance shifted, with the United States emerging as the sole superpower. Market economies were increasingly seen as more resilient, and institutions like the IMF and World Bank expanded their role in shaping global macroeconomic frameworks. In academic circles, the Soviet experience became a key case study in the limitations of planned economies and sparked new discussions about governance, reform, and the deep connections between politics and economic structure. At the same time, the legacy of this crisis left a lasting imprint on cultural and intellectual life across the post-Soviet space. Glasnost times had opened the door to new forms of expression. Literature, film, and music from this era reflected the sense of uncertainty, skepticism, and longing for change that permeated society. Scientists and researchers faced new challenges in securing funding and preventing brain drain, while international collaborations in fields like technology, space, and nuclear safety began to grow. Though the Soviet Union no longer exists, the lessons from its final decade remain relevant. The importance of balanced economic planning, institutional transparency, and adaptive reforms continues to shape debates around development models, especially in times of uncertainty. And the collapse of one of the world's most powerful states remains a reminder that even the most rigid systems can unravel not just from external pressure, but from within. Asian Crisis. The 1997 Asian financial crisis was one of the most severe economic events in East and Southeast Asia during the 20th century. It began in Thailand in July 1997, when the country was forced to abandon its fixed exchange rate system and let the baht float. What started as a single event quickly spread, triggering a chain reaction across financial markets in Indonesia, South Korea, Malaysia, the Philippines, and other emerging economies in the region. Exchange rates collapsed, stock markets plunged, unemployment soared, and millions of people were pushed into hardship. Before the crisis, Asian economies were experiencing rapid growth, attracting significant international capital inflows, especially under fixed exchange rate systems pegged to the US dollar. A surge in credit and short-term foreign borrowing was seen as a growth driver, but also concealed deep structural weaknesses. Property bubbles, high levels of foreign debt, weak banking oversight, and limited foreign reserves created a vulnerable environment. As the US dollar appreciated in the mid-1990s, Asian currencies became overvalued, widening trade deficits. The loss of confidence among international investors led to massive capital flight, sparking liquidity crises and exchange rate pressures that became unmanageable. On the 2nd of July 1997, Thailand officially abandoned its peg, triggering panic across the region. The baht's decline pulled down other currencies, with Indonesia hit the hardest. The rupiah lost over 80% of its value. The economy collapsed, inflation surged, and countless businesses went bankrupt. Public unrest escalated, leading to the resignation of President Suharto after more than 3 decades in power. South Korea, burdened by highly leveraged chaebols, had to secure a record $57 billion bailout from the International Monetary Fund, IMF, tied to wide-ranging reforms. Malaysia and the Philippines also entered deep recessions, with stock markets plunging and consumer and investor confidence collapsing. The IMF stepped in with large rescue packages, But the conditions: spending cuts, higher interest rates, and banking restructuring deepened short-term recessions and drew sharp criticism both domestically and internationally. Malaysia, however, chose a different path, rejecting IMF assistance, imposing capital controls, and maintaining fiscal policy independence, eventually recovering without international aid. The immediate impact was devastating. Indonesia's GDP contracted by 13.5%, while Thailand's fell by more than 10%. Millions lost jobs, and poverty rose sharply in just 1 year. Many banks and corporations failed. Stock markets across the region lost 40–50% of their value, and property prices crashed. Beyond the economic toll, several countries faced major political upheavals. Negative sentiment also spread to other emerging markets, including Russia and Brazil, creating a global domino effect. Some nations were forced to adopt strict fiscal measures and overhaul financial systems to restore confidence. By late 1998, however, signs of recovery emerged, driven by strong exports and weaker local currencies that boosted production. The 1997 crisis became a turning point in Asia's economic history. In its aftermath, countries across the region restructured their economic management models. Managed floating exchange rates gradually replaced rigid pegs, foreign reserves were built up as a safeguard, and banking systems underwent major reforms to tackle bad debt and strengthen oversight. The key lesson was clear: rapid growth brings systemic risks, and reliance on international capital flows, if poorly managed, can quickly trigger collapse. The crisis also ignited intense debates about the role of international financial institutions, particularly the IMF, pushing global reform efforts. One outcome was the creation of regional safety net frameworks, such as the Chiang Mai Initiative among ASEAN countries, China, Japan, and South Korea. The cultural legacy of the crisis remains vivid. In South Korea, the term IMF crisis became symbolic of a difficult but resilient era, reflected in films, pop music, and popular culture. In Thailand, the phrase Tom Yum Goong crisis linked the event to a national dish, blending economics with cultural memory. The crisis also inspired new economic theories, from second-generation crisis models to extensive studies on capital flows, institutions, and financial contagion in a globalized world. Universities, research institutes, and international organizations such as the IMF and World Bank continue to use the 1997 crisis as a case study in emerging market economics. Above all, the legacy of 1997 is not just about statistics, but a lasting reminder that sustainable development cannot rely solely on short-term growth or surges of foreign investment. It requires effective governance, strong regulatory capacity, and resilience against unforeseen global shocks. Dot-com bubble. The dot-com bubble was one of the most prominent financial speculation phenomena of the 20th century, tied to the rise of the Internet and e-commerce in the late 1990s. The epicenter of this wave was in the United States, particularly on the Nasdaq exchange, home to many young but ambitious technology companies. In less than 5 years, the Nasdaq Composite surged from under 1,000 points to a peak of 5,048 on the 10th of March 2000, reflecting enormous market confidence in the digital future. However, excessive expectations and unchecked speculation led to a rapid collapse. Within just over 2 years, Nasdaq lost more than 75% of its value. Hundreds of dot-com companies went bankrupt, and about $5 trillion in market capitalization vanished, leaving deep consequences for both the U.S. and the global economy. By the late 1990s, the U.S. economy was in a period of steady growth, with low inflation and favorable interest rates that encouraged borrowing. The emergence of the World Wide Web, e-commerce, and online services created an unprecedented wave of excitement. Virtually any company with a .com in its name could raise capital easily, even if it had no revenue or clear products. The Get Big Fast model encouraged startups to burn cash to capture market share, spending aggressively on advertising, promotions, and expansion, while profitability remained uncertain. Media coverage and investment banks amplified the hype, focusing on novelty and rapid growth rather than traditional financial indicators. Herd behavior took hold among both institutional and individual investors. Between 1995 and 1999, the market witnessed a surge of IPOs from internet firms such as Netscape, Yahoo, Amazon, and eBay. In 1999 alone, the U.S. recorded 457 IPOs, most from the tech sector. The Nasdaq rose more than 85% in just 1 year. The height of investor confidence came with AOL's announcement of its $183 billion merger with Time Warner, one of the largest deals in history, which later became one of the most infamous failures. Warning signs appeared in early 2000. Many companies were running out of cash. The Federal Reserve raised interest rates. Japan's economy weakened, and Microsoft faced a major antitrust case. Just days after Nasdaq peaked, massive sell-offs began, driving the market into a downward spiral. In less than 30 months, numerous high-profile .com firms, including Pets.com, Webvan, and Boo.com, collapsed. The aftermath of the .com bust was severe. More than 700 internet companies disappeared, and hundreds of thousands of tech workers lost their jobs. Major firms such as Cisco, Intel, and Oracle lost over 80% of their stock value. Venture capital funds suffered heavy losses, and many individual investors saw their savings wiped out. Nasdaq lost nearly $5 trillion in market value. Public confidence in investing, particularly in tech stocks and short-term speculation, was deeply shaken. Although the U.S. avoided a full-scale financial meltdown, the shock was considered a key factor in pushing the economy into the early 2000s recession. Still, the crisis left important lessons and positive long-term impacts. After the collapse, markets shifted toward more cautious approaches. Investors no longer poured money into companies simply for flashy names or growth promises. Instead, they demanded clear business models and demonstrated paths to profitability. The U.S. government increased financial oversight, passing the Sarbanes-Oxley Act in 2002 to strengthen transparency in accounting and reporting. Investment banks were fined for inflating valuations and conflicts of interest in IPO advising. One major takeaway from the .com collapse was that growth cannot substitute for real value, and herd-driven speculation poses systemic risks without proper controls. Despite the heavy toll, the .com bubble did not destroy the internet. It laid the foundation for the next generation of technology. Survivors such as Amazon, eBay, Google, and PayPal not only endured but grew into pillars of the modern digital economy. The crisis reshaped startup culture in Silicon Valley, fostering innovation and risk-taking, but with greater caution and strategic focus. On the technological side, network infrastructure improved, and the lessons of the .com era paved the way for Web 2, interactive internet platforms, social media, and today's global digital economy. From a period of extreme euphoria, the .com bubble became a clear example of the market cycle: expectation, speculation, disappointment, correction, and maturity. It was both exhilarating and turbulent, and it left a lasting mark on the history of finance, technology, and modern economic thought.